Hey, this is part 4 to our Intro to Options series, and here we're going to cover the Greeks. So the Greeks are important variables that determine the option price. Specifically, when we're looking at the change in prices. Okay, so theta is time, and we're going to show some symbols on here. The symbols aren't too important, but what is important is the Greek word and what it represents in English. So delta is price, and Vega is volatility. Okay, so why does an option price change? It's because the variables that make it up change, which was what we were just looking at. Time, it's always decreasing. So if you buy an option at a certain price, as it nears expiration, the price of the option will decrease. Price, it fluctuates up and down. That changes the option price. And volatility also matters. Okay, let's look into theta more. Options with expirations farther out are more expensive. There's more time for you able to make decisions and let your trade play out. This is an example. So this is on Robinhood, a SPY call expiring in 2 days. The strike price is $693, and you only have to pay 79 cents for it. Now let's look at the same strike price, but a month out instead. So here we can see this is actually $10.51. So it's about 15 times more expensive, and the only variable that we changed was the expiration, putting it farther out. So this shows that earlier on, an option has more value. And after you've bought it and time goes on, your option loses value. Okay, here's that 1 month as again. Strike price $693. The option is $10.51. Then with 2 days left, it's only worth 79 cents. Theta is what's causing this. And for every day that goes by, the option will decrease in price based on theta. So that's what theta is tracking. Let's look at that more. So our same strike price. And here we have the theta as a negative 24. So for every day that time goes by, this option is going to lose 24 cents per share, or $24 in total. And notice it's negative because as time goes on, the price of the option decreases by this amount. So the option loses 24 cents per share every day, which is $24 in total. So if you bought this call at $693, you have to pay about $1,050 for it. And then every day it would lose $24 in value at an increasing rate until the option expires worthless at $0. Okay, here's our example again. Every day, theta decreases the price of the option. The call buyer in this instance lost $9.72. So they bought it at $10.51 a month ago, and then with just 2 days left, it's down to 79 cents. So if they sold it at that point, then they would have lost $9.72 per share. The call seller is the other side of that coin. They gained $9.72. They sell the $10 call with a month till expiration, and then they buy it back with 2 days left for 79 cents. So they sell it, they get $10, and then they pay 79 cents to buy it back, and they collect that difference of $9.72. So option sellers like theta. It works in their favor, and it works against the favor of the option buyer. Let's look at our next variable, which is price, and this Greek is delta. As the stock price changes, the option price changes. So an example, Amazon is at $200 per share. If we look at the option, the $200 strike price has a delta of 0.53. What this means is that for every dollar increase in the price of Amazon, the option will increase by 53 cents. So Amazon stock rises to $201, and the option price will rise by 53 cents. Okay, so this is pretty straightforward. The delta measures the rate of change in the option price. And another point I want to bring up about delta, as price increases, delta increases. So we saw the example with Amazon where it was $200 with a delta of 0.53. As it goes up to $201, the delta does not stay the same. It increases. Another dollar increase, the delta increases with it. So it doesn't stay at the same delta. That delta fluctuates over time as the price changes. So you're asking yourself, well, delta measures the change in the price, but we can see that delta itself changes. So there's another variable that's actually impacting this, which is gamma. So delta is like the first degree of change that's measured. Then gamma is like a second degree of change. It's a level deeper. Gamma is measuring the change in the delta. Now, we're not going to cover gamma in this series because it's really not needed to trade options, but it's important to understand this principle that the delta does not stay the same. It changes as price changes, and the variable that's impacting that change is gamma. Our third variable is volatility, also known as Vega. So look at this chart. It's measuring two different stocks. The black stock is not very volatile. It never goes very far beyond a certain price. It kind of hangs out around one area. That's a low volatility environment. Look at the pink line. It shoots up, it shoots down, it has these big moves. The pink stock is more volatile. Okay, it would have a higher Vega. So volatility, it's an important concept in the price of the option. It's one of the variables that determines the price of the option. High volatility is going to have a higher option price, and a low volatility will have a lower option price. So if you're trading a stock in the black here, this would be something like Ford or 3M, something that there's not too many big surprises, not too many changes to the industry. Compare this to a high volatility stock. This would be something like Nvidia or GameStop or Bitcoin. These are things that change a lot with their moves are large. They don't stick around one price. So an option like that will have a higher option price because the chance of a large move is greater. So there's more profit to be made for the buyers of that option. So a low volatility stock, the stock is not expected to move much. This gives a lower option price. So there's less potential baked into the price of the option. A high volatility stock, it's expected to move a lot. So a lot of that potential movement will be baked into the price of the option. You're paying extra for the wider range of possibilities. So the option seller needs to be compensated with that risk, right? If the price is going to move around a lot, then they need to be compensated for that potential to have a large loss. Let's dig deeper into option pricing. If there are many days to expiration and high volatility, will the option price be high or low? Well, it's going to be a higher option price. There's going to be a lot of time and volatility baked into the price of the option. Okay, next example. If there are fewer days to expiration and low volatility, will the option price be high or low? The option price will be lower. If there's fewer days to have a chance to profit, then a buyer is not willing to pay as much for that. And if there's low volatility, once again, that reduces the range of possibilities for the buyer. Let's look at more examples. Let's say you buy a call expiring in 2 weeks. Okay, a week goes by and price and volatility stay the same. So what do you think happens to the option price in this example? It goes down. It has fallen due to theta. Price didn't change, so delta didn't move the price any. And volatility stayed the same, so that didn't matter. The only variable that changed was time, and it went down, so the option price fell. Example 2. Let's say you buy a put expiring in 2 weeks. Okay, so you're buying a put, you want the market to go down. A few minutes later, the stock falls hard from the CEO making a bad tweet. What do you think happens to the price of the option? It will rise due to delta and Vega. So in our example, the time really didn't change. It was only a few minutes. So especially with 2 weeks left, that's going to be a negligible change on the price of the option. But what did change was the stock fell hard from this news. And usually when a stock makes a big move, then the volatility increases. So Vega went up. So our put is looking good. We're making money. The stock went in the direction we want and volatility increased. And once again, not much time had passed, so theta was irrelevant. Okay, let's continue with this example. 1 week later, the CEO is replaced and the market likes the new CEO. The share price goes back up on the good news. So what has happened with the price of this option? Well, in one way, the option price has gone down because some time has gone by. We were at 2 weeks to expiration, and now we're at 1 week. That's going to be a decent amount of theta decay, which is the decay of the price of the option due to theta. And also, the stock price went up, so the put price falls. If we were call buyers, we would have made money because the stock went back up. But we were put buyers. We want the market to go down, and it went in the wrong direction here, so the option price has gone down. So for both reasons, the option price has fallen. Guys, thank you for watching. That's all for this video. The next video, I share my options calculator. This is a calculator that I made, and it's really fun to use, and it teaches you a lot about the options and how they change prices. I also use it for myself in predicting future changes in the option price. So definitely make sure you watch that video.